In this video, I'll be sharing with you a number of strategies that can be implemented with the use of market depth. These strategies will be able to help you determine a more precise level for your entry point, your stop loss exit, as well as your potential profit-taking exit. In technical analysis, a price support level is often a good place to enter a long trade. However, key support levels might not always be that obvious to a trader. This is where market depth can be used to determine a more precise price support level as well as the strength of that support. From this price chart of Fraser's Commercial Trust, we can see that there is a fairly strong technical support at around 125 as the price has bounced off numerous times at this price level. When we observe the market depth of this counter at that moment, it is also clear that there is a large quantity of 500,000 shares being queued to buy at 125. This affirms that 125 is indeed a strong technical support level and is unlikely to be broken unless the selling pressure is very strong. As such, you can confidently enter a long position at 125.5 or higher so that you can get into the trade ahead of the 500,000 shares queuing to buy at 125, with an anticipation that the rebound could take place around this level. Entering a trade is just 1/3 of the work done. In order to manage your risk, you also need to determine your stop loss exit level in the event your trade failed to materialize in the anticipated direction. Stop loss level is usually placed somewhere below a strong technical support. You can also use market depth to identify if a technical support level is strong enough to protect you from triggering your stop loss just below it. In this particular example of High Flux Limited, we notice a big quantity of around 400,000 shares respectively queuing to buy at 54 and 54.5. As such, it is prudent to place a stop loss below this strong support zone at 53.5 and lower. Should the selling pressure be strong enough to overrun both the big quantity of shares queuing to buy at 54 and 54.5, this suggests that the probability of the up move has diminished significantly, and it might be a good idea to cut your loss at 53.5 and lower. If you entered at an ideal entry price and your stop loss exit has not been triggered, you now need to figure out the final third of your trading decision, which is to decide where to take profit. One method of determining a profit-taking level is to identify the key resistance and place the profit-taking level just below that key resistance. In this example, we are trying to establish a good level to take profit on High Flux Limited. From the price chart, we observe a strong technical resistance zone between 63 and 65. A closer look at the market depth chart suggests that there is a large quantity of 200,000 shares queuing to sell at 63. This helps us affirm that 63 cents is likely the precise key resistance. As such, an ideal level to take profit will be at 62.5 or lower. By establishing the profit-taking level at 62.5 or lower, you will be able to exit with a profit ahead of the big quantity of shares queuing to sell at 63 cents, while having the comfort of mind that the price is likely to reverse south around that level as well. All in all, market depth can be very helpful in identifying the precise entry level, stop loss level, and profit-taking level. Coupled with these strategies I have just shared with you, you can now be more confident and disciplined in managing your trade entries and exits.